Good evening, everyone, once again. Welcome to another edition, or welcome to Professional Associates, right? And welcome to another edition of Performance Management. In today's class, we shall solve question on marginal costing. In our last class, we were able to bring out some formats for marginal costing, which can be shown on my screen, right? Which can be seen on my screen. So we actually look at the format of marginal costing, but now we need to look at an illustration to marginal costing, right? And I said that marginal costing is a variable cost, right? That values its what its product, its production using variable cost. It value its product using the what variable cost. Right? Don't forget this. It is very what important, and as well as it value its inventory using variable cost. And I believe that it is like I think we had this class on Sunday, right? So I believe that most of you minus Ruth that she's just joining us. Most of you would have gone through the recording as well as pick some of the relevant stuff in that class, right? Now, in today's class, let's quickly look at. I have an illustration here for those who have actually paid for the material. You've gotten your material. I've sent it to you. So, right. So just follow me as we move as well, right? And this is what you need to know. I've separated them from this. Okay, this is absorption costing. We are not there yet. Oh, this is the illustration we'll be looking at. Okay, this question is adopted from ACCA past question by Kaplan, right? And it is examinable as well, right? Let's quickly pay attention to this question, right? And we'll be looking at question one on my screen. Please quickly, kindly confirm if you can see my screen and before we start the calculation, before the okay, that's fine. Okay, if that is established, then if you can see my screen, please take notes of what will be analyzed. You see, performance management is based on analysis, right? We in Next Gen Professional Associate, we will teach you performance management. You will not only score 50 or no, you will score above 50. Just pay attention to detail, right? And that is how it is. Now, look at this question here. Next Gen Professional Associates is into production of sugar. We are into production of sugar. The selling price per unit, don't forget in the format I gave something like this that you may be given selling price per unit. Now, the selling price per unit means that each of the sugar will cost what is estimated at what 45 naira, which means that each of the sugar we will sell it. Selling price for each of them is 45 naira. Now, that is direct material costs are costs that are not avoidable, right? That are avoidable, right? Direct material costs are costs that can be traceable to a particular production unit. Of course, when you want to produce, you must use material to produce. Is that not so? You must use material. Is that not so? So that is when we have direct material cost per unit, which means that each of the sugar cost, it will cost them what? 11 naira per unit. 11 naira per unit. Now, direct labor cost per unit is what? Which means that each of the units of the sugar we cost them for direct labor will be what? 8 naira per unit per one class per one. Now, if that is established, we still have some other costs, which is the variable production overhead cost is what? Is 4 naira, which means that their variable production cost for each of the sugar, each of the units is 4 naira per unit, right? Now, fixed production overhead cost per unit, you can see that we're given fixed production cost per unit as well, right? As what? As 3 naira per unit, which means that each of them, each of the units will cost 3 naira, right? Now, another thing is variable selling overhead is what? Is 5 naira per unit, 5 naira per one, 5 naira per one. Plus, who can give me the difference between variable selling overhead and variable production overhead? Who can give me the difference between the two? Variable selling overhead and variable production overhead. Please kindly unmute your mic. So if you get it right, free material for you. If you are not yet buy the material, right? Free material for you. Rest assured with that. Okay, what is the difference between the variable selling and variable production overhead? Okay,
Okay, just an
Elijah,
attempt. Yeah, good evening.
good evening.
Good evening, everyone. Okay, variable. I'm trying to get a question again.
Okay, what is the difference between variable selling overhead and variable production overhead?
Okay, variable production.
We can't hear you.
Very, just let me just explain it the way I understand. Variable production overhead.
Okay,
It's usually
we can't hear you. Your network.
the
I can't
level of
even hear you.
activity. Okay, can you hear me now?
Yes, I can hear you now.
Okay, so variable fixed overhead, right?
No,
It's
variable production overhead and variable selling overhead.
okay. Variable production overhead. Variable production
Yes.
overhead is, for instance, it can actually be fixed. But when it becomes variable, that happens when the production output changes.
Go ahead.
Yeah.
Are you done?
No, I'm not done. Why variable? What's the second one again? Variable selling
Variable
overhead,
selling.
right? Variable
Yes.
selling overhead does not have any fixed elements. It is variable in nature, so to speak.
Interesting. Well done. Interesting. So, okay, I have which other person I have here? I have Sumi Sola. Sumi Sola, kindly unmute your mic. Unmute your mic.
Evening.
Yeah, good evening.
Yeah, variable selling overhead is attributed to selling. It does after production. While variable production overhead is attributed to production, that's before the item has been produced.
Interesting.
Yeah.
Okay, I have here Ibrahim Olamile. Ibrahim, kindly unmute your mic. Namesake. Okay, Ruth. Okay, kindly unmute your mic quickly.
Okay, good evening.
Good evening.
Okay, variable production overhead is that variable that varies alongside with production. While variable selling varies, while variable selling overhead is a cost that changes with sales volume.
Interesting. Well done. Now, that's good. I think that's all. That's all. Thank you. Thank you. Thank you. Thank you. Interesting. Who is the first person that the first Elijah, you mixed something up, you didn't get it. Why? Who is the first person that answered this question? What is her name? Oh, wait, I've forgotten your name. Unmute your mic. I've forgotten your name. What is the person's name? Oh, please unmute your mic. I've forgotten your name.
Miss Ola,
You say, okay, Sumisola, just send me DM immediately after this class, right? Just send me DM, okay? Well done, Sumisola. So, and that is how it is, right? The variable selling, you can put down your hands, please. The variable selling overhead attributable to sales, while the variable production overhead attributable to what? To production. It's attributable to what? Production. And that is what it is. Then we have fixed selling overhead as 2 naira per unit, right? We have we have that one as 2 naira per unit, and the fixed administrative overhead is also 3 naira per unit. Per unit means per one, right? per one. Now, fixed cost is incurred on a normal annual activity level of 96,000 units, which is the fixed overhead cost, right? Which is unavoidable cost. Is normal levels of activity is 96,000 units, and is expected to be incurred at a constant rate throughout the year. Throughout the what? The year. We will not make use of all these things. When we get to absorption costing, how we analyze how it comes, how we need to make use of this fixed overhead cost here, right? Now, they are telling us that they attribute fixed overhead cost to a particular numbers of units, which is 96,000 units. Now, we are given January, February, the sales in units, the production, as well as the assumed no stock to January 1st, 2012, right? Prepare profit statement using absorption and marginal costing techniques for the two period, right? For the 2 months. Reconcile the profit and explain the reasons for the what? For the differences, if any, right? Now, in this case now, we will start with marginal costing because I will only explain the marginal costing in our what? In our last class, right? And just observe, please ensure you are with your calculator, right? So here we have a suggested solution for those who have the material. I will send the suggested solution to you immediately after this class, right? So we have suggested solution, right? So suggested solution, right? Now, if this is established from our format, what do we have? From our format that we have, first, you need to write the name of the company that you are dealing with, and it is what? Next gen, because your presentation in performance management also matters, right? Next gen professional associate, right? Associate, right? So if this is established, you put it is next gen professional associate. What next? Then you start your sales class. You start with your what? With your sales, right? From the format. So you can have sales. Don't forget that you have your selling price given to you in the question, right? If you look at the format given to you, you will see that I said selling price times the unit produced. Don't forget, by the sales unit. Selling price times the sales unit. Sometimes the question may give you sales unit and the same thing. Okay, it is even given here. The sales unit and production unit, they are two different things. No, it is when you produce before you can be able to what? Sell. Make a what? Make a sales. Make a sales, right? And it is from what? January, January and what? January and February, right? January and February, right? So I'm coming, let me quickly bring this down. It is for January and what? And February, right? So, so we can have here the sales, right? We can have sales for January, then we can have for February as well, right? We can have for January and we can as well as for what? For February, right? So what is the selling price, class? What is the selling price? What is the selling price, class? Giving you the question, what is the selling price? Quickly, if you have the material, you can quickly check.
5 naira.
Okay, I'm coming. Let me bring this down so that we can move fast. Okay. I think so. We can move faster on this. Okay, that's fine. Okay, so what is the selling price, class? What is the selling price, quickly? What is the
11
selling
naira.
price? Okay, 11 naira.
11
Okay, 11 naira times. What is the
5 naira.
sales in units? What is the sales in units? What is our
7,000.
sell? What is the selling price, class? Someone is saying 5 naira. Someone is saying 11 naira. So which one is correct now? Selling price, oh, class, screenshot it.
Uh,
This is the selling price.
45.
What's five
Ah,
naira? What's 5 naira?
okay, oh, okay, oh. It's 45 naira. Oh. I did not know where you see your own 11 naira. Oh. Hmm. Now, times the sales unit. What is the sales unit, class? For sales, what is sales unit? I said just screenshot this part. Screenshot it and
7,000.
let's move on.
7,000.
Please screenshot this and let's move on, please. I don't want to be scrolling up and down. So just give me figure and let's move on. 7,000, right? 7,000 units, right? 7,000 units, right? So just multiply what do you have? 7,000 units, what do you have? When you multiply, what do you have? What do you have?
315,000.
350,000.
Okay, 315, right? 315. 315,000, right? For January, what of for February? What do you have for February? So what do you have for February? You do the same thing. What is your selling price? You have the same selling price. Sometimes, class, yeah, sometimes you may have different selling price, but in this question, it's just one selling price that is being given. You can see that you have different sales. Is that not so? You have different sales. What is the sales? 8,750. Is that not so? 8,750, class. That is the unit, right? 8,750 units, right? So if this is established, what is the sales? Class, what is the sales? Quickly. What is the sales?
393,750.
Okay, good. 396,750.
93, 93.
Okay,
393.
393. Okay, that's fine. Thank you. Thank you. What next do we have? So from our format, after this, you have your variable production from the format, variable production costs. Of course, when you make a sales, before you make that sales, you will incur some costs that can be traceable to a particular production unit, right? Don't forget that marginal costing is based on variable cost, right? It is based on what? It is based on variable cost, right? Now, in this case now, because the requirement says that prepare profit statement using absorption and marginal costing techniques for the 2 months. You can say from your headings, please always give it heading. You can say computation or determination of profit statements using, right, using marginal costing, right? Using marginal costing. Please, all these things are very important. Please, these are just little things that gives mark in exam, right? Your presentation is very what? Important, right? Now, if this is established, then we have somewhat the variable costs that they actually incur this into the what? Into the production, right? We actually have somewhat some variable costs that were what? Incurred directly in the what? In the what? In the production. Now let's quickly go and check. So let's quickly go and check the variable costs. You can see that we have from our format, what do you have? You have direct material. You can see that you have direct material, which is 11 naira. You have direct labor as well, which is what? 8 naira. Is that not so? From the question given to us as well. Now, direct material, right? So what will be the cost of the direct material? Don't forget the format I gave you, right? What is the direct material cost per unit? What is the cost per unit? The cost per unit is 11 naira, class. 11 naira per 1 unit, which means by per 1 unit of production, per 1 unit, right? Now, 11 naira, that is 11 units, right? Or you say is 11 naira, sorry, 11 naira per unit times what is the unit produced for January? The unit produced for January is 7,000 units, right? 7,000 units. Now, what do we have? What is the cost? What is the cost, class? What is the cost? Multiply.
Seven
Adeola,
7,000.
7,000, right?
Sir, you are using is it production units you are supposed to use or sales units? You are using the sales units.
Okay, sorry. Thank you. You can see. That is a very good one. Thank
Also,
you for
one
the
more thing, sorry. The opening inventory, you didn't do any working on
Thank
the
you,
opening
thank
inventory.
you, thank you, thank you. But thank you, it shows that you watched that video. Well done. Now, although the opening inventory, you can make it after the direct, you can put it after your direct material, direct labor, because in performance management, there is no specific format, just like the way I normally say, right? There is no specific format, right? Now, in this case now, let's quickly go back and from the format, let's quickly go back from the format. Please don't forget that this direct material is attributable to production, not sales units. Direct material. Why do you want to buy this material? Is it not for you to produce, right? So definitely anything you are using, you need to attribute it to what? To production. Is that not so? Now, the first thing we need to do now is, let's forget the direct material. Let's talk about the opening inventory. Let's use the opening inventory, which is the opening stock, right? You can say opening stock or inventory, right? So inventory. Now this will be our work one. Let's just use it as work one, right? So now, how do we get this opening inventory? Don't forget that in this question, we were told that assume no stock on what? No stock on January 1st, 2012. Is that not so? Now, we need to determine our opening stock for February. If, for instance, there is no opening stock for January, at least there should be opening stock for February, right? Which is the what? Inventory, right? So in this case now, we can still have here, you can still have here workings. This will be our workings, right? This side will be our what? For our workings, work one, right? So we can have determination of opening, determination of opening. Someone should spell opening. Oh, hey, wait. Determination of
Okay.
opening. OP what?
OPENING.
Okay, thank you. Opening and closing inventory. We want to determine the opening and closing inventory, right? So for January as well as what? For February, right? Now, in this case now, class, there was, the question says that there was no opening stock. Is that not so? So you can say opening, you can just write opening, inventory or stock, right? So, you know, it will be in units. Is that not so? It is not given. You put nil, right? Now, don't forget that in January, there is a production. They have a production of what? What is the production, class? 8,500, class. 8,500, right? And they make a sales of 7,000. Is that not so? Now, in this
Yes.
case now, you can have production. What is the production again? Sorry. What is the production?
85.
85.
Production.
8,000.
8,500. Now, what is the sales? What is the sales?
700.
7,000.
7,000 units, right? Please mute your mic. You are not talking, please mute your mic. Now, right? Now, what will be the closing stock? Now, you can see that PM is logical. You produce 8,000, right? You produce 8,500. Is that not so? Then you now make a sales of 7,000. Definitely, you have some goods that is unsold. Is that not so? You have some goods that is on what? That is unsold. So therefore, 8,500 minus 7,000 will give you your closing inventory. We give you, you can see PM is logical. You have to think, you produce 8,500. You make a sales of 7,000. Definitely, you have some goods that is unsold, right? That will give us what? The closing what? The closing inventory. So you can now have here closing inventory, right? Which one are we using? Is it stock or inventory? Anyone? Inventory, right? Inventory. So now, when you look at this, what is the difference, class? What is the difference between these two? That is, what is the difference?
1,500.
8,000,
1,500.
1,500 unit, right? So this gives what? 1,500 unit, class. And this is how I explain it in the last class when I was doing the what? The format, right? Now, class, the closing stock of January will be opening stock of February. So just put the units. Don't forget that it is based on units. Just put the units here, 1,500, right? Meaning that the closing stock of January will be opening stock of February. Class, are we still together? Now, definitely you will have a production in February. Is that also? You have a production in February. Class, what is the production in February? What is the production for February?
7,750. 7,750.
7,000, 7,750, right? Right? Now, what is the sales? What is the sales? You can see production is
8,000.
7,750. You can see that production is 7,750. Sales is what? 8,000 what? 8,750. Thank you. Just be giving me that figure like that. 8,000, 8,750, right? Now, what will be the closing inventory? What will be the closing inventory? Don't forget that you need to minus your sales from all these things. So definitely so that you will have a closing inventory. You add your opening inventory together plus your production. So when you add it together, you subtract it from your sales, then you will have what? Closing inventory. Class, what is the closing inventory here? Quickly, what is the
500. 500.
why 500? So that is five. See, class, it is not 500, it's 500 units, right? You are in performance management class, right? It is what? You are now a cost accountant, right? You are now a management accountant, right? It is 500 units, class, units. Now, if this is established, right? Now, we've gotten our opening for February. We will also calculate our closing stock, right? Now, the next thing you need to do, this is your work one, right? Now, the next thing you need to do is that if your there's no opening in January, is that not so? There's no opening in what? In January, right? Right? Now, if there is no opening in January, so you just put your dash here that there is no opening in what? In January. Then you move on. Don't forget that you already have your opening in February. Is that not so? So now, after if this is established, let's go back to our direct material cost. Now, direct material cost attributable to production. Class, material attributable to production. Right? I just want us to finish the January before we now move to February. Now, direct material is attributable to what? Production. Oh, production. I said it. Oh. Now, if this is established, now how many units did they produce? For January, they produced 8,500 units, right? Is that also 8,000? So what will be the direct material cost? Class, multiply. What is give me figure, please. Multiply. What do you have? Figure.
93,500.
93,500.
500.
93,500. Now, if this is established, right, from the question, we're given the variable cost. Don't forget that we are picking from the variable cost, right? After your opening inventory, you will spend money in your production. Your direct material as well, your direct labor, you will use them in the production because without all these people, you can't produce, right? Before you say you want to sell, right? From the question, we were given direct material as well. So you are direct labor. So we can have direct labor, right? Direct labor. Is that not so? So what is the cost of direct labor per unit? What is the cost of direct labor per unit, class?
8 naira. 8
Thank
naira.
you. 8 naira. Please, immediately after this class, please get your material, please, because this will make work easy. I don't want to be going up and like scrolling up and down, be showing you this is the figure. Once you have your material with you, then we are good. You have it printed or you have it on your system, then you just be looking at it then so that we can be able to move more faster, right? Now, if that is established as well, is 8 naira, right? Which is given in the question as what? Direct what? We can see it here as your direct what? Direct material, right? Now, if this is established as well, we need to multiply it. So multiply it by the units as well, by the units, which is what? 8,500 units, right? 500 units. So when you multiply, what do you have? What do you have? What do you have?
68,000.
What do you have?
68,000.
68,000, right? Okay, good. So after the variable, after this direct material, which other variable costs are we given again? You can see that we're given variable production overhead cost. You can see VPO, which is 4 naira. Are you seeing
Overhead.
it? Which is
Variable
4 naira
overhead.
per unit. It is 4 naira per unit. 4 naira per unit class, right? You are not a management accountant, right? Now, this is if that is established, variable production VPO, right? Overhead. Please don't do abbreviation in exam, right? It's just for the purpose of this class, right? So what is the unit cost? What is the variable cost per unit? It's 4 naira,
4
right?
naira.
Okay, 4
Yes.
naira, thank you. 4 naira times. So what is the unit produced as well? It's still 8,500 units. Don't forget that I said there is no specific format for performance management.
34,000.
What do we have?
34,000.
34,000.
Yeah.
Okay, that's fine. It seems you are far from that. Okay, 34. Is it 34,000?
Yes, it is.
Okay, 34,000. Thank you. So after, if this is established as well, the next thing you need to do is your closing inventory, right? So what is your closing inventory? Please mute your mic. Who is that? Please mute your mic. Okay. So if that is established, closing inventory, right? Don't forget
So
that we
for
already determined Don't forget that we already determined our closing inventory for January, which is 1,500 units, right? Units, right? Now, inventory, the spelling, okay. Inventory, right? Now, how many units in January is 1,500 class? Is that not so? 1,500 units. Class, 1,500 what? Units. Are we still together? 1,500 units. Class. Now, times, who can give me the answer? Times what? Times
times
what?
23.
2,500.
23.
Times 23. One. Times what? Again. Who again? Hello? Who can give me figure again?
Times
Times what
45.
again?
45.
Times
45.
45 times
45.
45. 45, okay? Noted. The first person say 35. The second person say 45, right?
I said 23, not 35.
Okay, 23. Okay, 23. Let me note it down.
Yeah,
23.
23,
Adekoya. Okay. Okay, 23. That is noted. The other person says 45, right?
23.
Right? 45, right? Now,
45.
don't forget. Now, it's okay. Thank you. Thank you. Don't forget that in our in our last lecture, when I was analyzing the format, someone say, I did not understand. This is when you will now need all those things, right? I said that marginal costing value its inventory using the total variable cost per unit. Variable cost per unit. That is what you will use to value your inventory. Because marginal costing is a variable costing. It's a variable cost. It is with what? Variable cost. So when you want to get the value of your inventory, either opening or your closing inventory, you use the the variable cost, the total variable cost per unit. Total variable cost per unit. That is what you will use to value your what? Inventory. Class, are we still together? Now let's bring the total variable cost per unit out. You know, we already have it, direct material, right? We already have it as direct material, direct labor. So let me just bring it out. Determination. There's no need for that. Let me say this is work 2, right? Determination of variable cost per unit, right? Variable cost per unit. Now, there is direct material, DM, What is the direct material cost? Direct labor. What is the
11
cost,
naira.
class? Okay, 11 naira.
Direct
Good. Thank
material
you.
11.
11 naira. What is the direct labor? What
8
is the direct
naira.
labor? 8 naira. Good. What is the VPO? Variable overhead.
4
Variable
naira.
production overhead. Okay, VPO. VPO means variable production overhead, right? Please don't abbreviate to. Okay, is what 4 naira, right? 4 naira. You can see the variable cost per unit, right? Determination of variable cost per unit. Variable cost per what? Per unit. Can you see it? Now, add it together. What do you have? The total. What do you have? What is the total? What is the total, class?
23.
Okay, 23. Okay, 23. That is a very good one from you. Thank you for that. So this is what? This is 23. You can see this is your what? Your variable cost per unit. And this is what you will use to value your inventory, either opening or closing, because marginal costing is a variable costing. It deals with what? Variable cost class. Now, you multiply by 23. Is that not so? You multiply by 23 naira per unit, class. 23 naira per unit times 1,500 units, right? We give you what? A value. How? Thank you. So what is the
34,500.
figure? You say?
34,500.
Okay, 34,500. Don't forget that it is closing. It will be in jacket. Is that not so? It will be in jacket. So you wear jacket too. So now, if this is established, class, now don't forget that we want to go to February, right? Now, the closing inventory. You can do all this your workings that I did here. This 11 naira times 8,500 units. You can do it in your workings. You can put it in your workings, right? You can put it there, right? Now, the closing inventory here of January, class, will be opening inventory, right? In February. The cost, just pick the cost like that. Your closing inventory of December will be opening of January, right? So this will be, so the opening will be what? 34, okay? 34 34,500, right? 34,500 class. So you will still have the same thing when you have your direct material. So you can see sometime the direct material for January may be different from February given to you in the question. But in this case, we only have one direct material. So we will assume that direct material is for January as well as what? February. But they have different production. From the question, you can see that they have different production. They have different sales units. You can see. Now, please pick, pick, um, pick. Okay, please take note of that production for February as well as the sales. Okay, production only. That is 7,750. Someone say she can't hear me. Please confirm if you can hear me. Ade?
Yes, I can hear you.
Yes, I can hear you.
Okay, that's fine. Okay, maybe it could be our network actually. I saw the message on the platform just now. So please check your network. Could be your network, right? Please check your network. Thank you. Now, if that is established as well, so we have 11 naira, right? Times. So what is the unit produced for February? What is the unit produced? Class, what is the unit?
7,750.
Okay, 7,750. It seems others are sleeping. Oh, my people, wake up. Don't sleep. Oh. So what do we have? Please give me figure. Give me figure, please.
So we have 34,000. Different for the what's it called? 85,250.
85,250.
250.
Okay. So next. So we have the same direct. So what is this one is 8 naira
8 times
times
60,
7,000,
7,750.
7,750. What do we have, class?
62,000,
40,000.
62,000.
62,000 naira, right? 62,000. So if this is established as well, we move. So this is 4 naira. Don't forget that I said they may give you different direct material for January and February. Please, please. But in this question, we will assume that the direct material cost for January is still the same thing for what? February. Please give me figure, please. Give me figure, please.
So we have 31,000.
Okay, 31,000. Good. 31,000. Good. So now, what will be the cost of closing inventory of this? Don't forget that we already have, what is the closing inventory? We can see
500.
that the closing, thank you. The closing inventory for February is what? 500 units. Adekola, it is not 500, it is 500 units, right? When you are dealing with units,
500
call the
units. Sorry.
units, thank you, 500 units, right? Now, if that is established, you can have 500 units times, right? The total variable cost per unit, which is 23 naira per unit, right? 23 naira per unit, right? You can see how marginal costing is, right? Very simple, right? So what do we have? Multiply, what do we have?
11,509.
Okay, 11,500. That's good. It shows that you guys are active. Well done. So 11,000, sorry.
500.
Okay, 11,500, right? So you put it in jacket. So please, I need figure now. So you add from 93,500 plus 68,000 plus 34,000 minus 34,500. What do you have? Quickly, someone should give me the figure.
For January, 161,000.
161,000. 161,000.
Okay, 161,000, right? For January, for January, right? Right, class. Are we still,
February.
are we still to,
February.
so
Are you
what's
getting me,
for
sir?
February? Yeah, for February is what?
201. 201.
You say?
201.
Okay, 201.
250.
201. I can hear you. Just
201.
someone.
250.
Okay, 201, 250. Okay. 201, 250. Okay, fine. Okay, please deduct it. Let's deduct it from our sales. Remove it from your sales, right? Remove it from your sales. What do
For
you have?
January, we
Remove it.
have 154,000. January
154,000.
154.
Okay, 154. Good. Thank
154.
you. Okay, thank you.
20 something.
For Feb, 192.
154, right? 154. 154,000. So by
192,500. For February.
one
92,500.
192
192,500.
500. Okay.
19500.
Now, thank you. Now, you can see that we've affect our variable cost, right? Don't forget that the question gave us fixed production overhead cost. Is that not so? It is fixed production overhead cost. Don't forget that marginal cost charge fixed cost as a period cost, right? As an expenses, right? Now, here we have another fixed selling. Fixed selling, fixed, it is fixed selling. You charge it to the expenses as a period cost. We have fixed administrative. You charge it as a fixed cost as well. Now you have what? Variable selling, right? Variable selling will goes with what? Sales. It is not part of your production cost. It is not part of the variable production cost, right? That is why we did not include it as part of the variable production cost. So you cannot say variable production overhead, right? Overhead class. So variable production overhead is 5 naira. So 5 naira times what? 5 naira times what? class, 5 naira times what? Variable selling,
85.
7,000.
5 naira times what?
7,000.
Thank you.
7,000.
Times 7,000 class. Oh, it's times 7,000. Oh, variable selling goes with sales. Variable selling goes with sales. So what do we have? What do we have? Quickly give me figure.
That's 5,000.
5,000.
5,000.
35,000, right? So this is 35,000, right? 35,000. So please calculate for this as well. What do we have here? What is we have 5 naira times, what is the sales? 8,000, 8,750, right? 8,750. Please, if you have not watched our previous class on marginal costing, you can't be I can't teach you performance management and you don't understand and you don't pass. No, it is not possible, right? Unless if you fail to actually put in your effort, right? So after this, it is not over, right? You need to you need to solve questions, like some of the questions on the material. Ensure you attempt them, right? Of course, we'll do one or two, then we move on, right? Now, if that is established, so what do we have here? What do we have here?
33,750.
33, 7,
43,750.
okay,
43.
43. Okay, 43, 750. Okay, good. So, what is the contribution? Now, this shows that your cost, your sales minus your variable cost, sales minus your variable cost will give you your contribution, right? Will give you your what? Your contribution. So, minus your 154 minus 35. What do you have? What do you have, class?
109,000.
I'm coming. Please, the person should mute your mic, please. Who is that? Please mute your mic. Okay, that's fine. So, what do you have for the first one? What do you have?
119,000.
119,000, right?
119,000.
So next, what do we have next?
148,750. 148,750.
148,750. So this is your contribution, right? This is your what? Your contribution. Don't forget that in performance
750.
management. Okay, 8,750. Okay. 148,750, right? Hello?
Yes.
Okay.
Yes, yes, yes.
So the person that
Yes,
is complaining on the group chat that no one is allowing, so you just want to join now. It is well. So if that is established, so the next thing is your fixed cost, right? Is your fixed cost, right? So before we move to the fixed cost element, right? Don't forget that what we did here is just the sales minus your cost. You have your contribution. Take note, your sales minus your cost, minus your variable cost, you have what? Contribution. Because when we get to break-even analysis, we will still make use of all these terms, right? So, the time is 7 minutes. Okay, before we move on, right? Okay, you can ask or mute your mic and ask your question.